Okay, welcome back everyone and good afternoon. I hope everyone's having a great day. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to talk about the top 3 income strategies, specifically using weekly options. And I'll talk a little bit about these 3 option strategies, and more importantly, why weekly options are suitable for many of these income generating strategies. Now, the goal of today's webinar is the fact that each one of us, as far as our portfolios, are quite different. We have different goals, we have different portfolio sizes, and we have different strategies that we like to trade. So today what I want to go over is, or the goal of today's webinar is to make sure that regardless of what type of portfolio you have, regardless of how you want to utilize your portfolio, we want to make sure that you have an option strategy that you can utilize pretty much at any one time to generate income for your portfolio. So what this means is that regardless of whether you own some stocks, or perhaps you want to purchase some stocks, or simply you just have a directional outlook on an underlying stock or ETF, we want to show you the different strategies that you can utilize options for to generate across any of these specific scenarios. Now, because we're going to cover 3 different option strategies today, I'm just going to spend more of an overview of each one, meant to introduce the different flavors, if you will, that you can utilize options for. And these are not going to be in-depth strategies for each one. If you want to learn more about each one of these specific strategies, we do have separate webinars on each one. So if you want to learn more, please, you can go ahead and do that through our video library, which I will direct everyone to at the end of this webinar. And just for a bit of a housekeeping, this webinar is recorded. So for those of you that want to follow along at your own pace, we will send everyone both the recording and the slides afterwards so that you can review the webinar that we're going to show you here today, but also show you how you can utilize OptionsPlay for the other strategies as well. So if you want to learn more about cover calls, cash secured puts, and credit spreads, those are the 3 strategies we'll cover here today. I will direct you to the specific webinars to learn more about those in depth. So today what we're going to do is we're going to spend about 20 minutes using the slides. I'm actually going to spend the least amount of time on slides today. I'm just going to use them to introduce the strategies. I'll talk a little bit about the best practices for each one of these strategies, but I think the best use of our time is to actually show you OptionsPlay and how to implement the things that we're teaching here today, because the goal of this webinar is to make sure that not only do you learn about the strategy, but more importantly, you know how to utilize the tools that are available to you to implement these strategies. So we want to show you some live examples using OptionsPlay. I'll even take some requests from the audience, and we'll take a look at those using OptionsPlay so that you understand how to utilize the platform that you guys have access to. So with that, let's go ahead and get started. Just a quick disclaimer. What I'm going to be talking about here today is purely for demonstration purposes. They are not meant as a recommendation or a solicitation to trade any specific securities. Now, for those of you that are brand new to OptionsPlay, you have free access to the tool that we'll be showing you here today. It's available to you at this link here at the bottom, which I will send in the chat window. And as part of having access to the OptionsPlay platform, you have bi-weekly options education webinars, just like the one that you're on here today. And we have a free on-demand options video library that's extremely useful for those of you that want to follow along at your own pace and learn about some other topics that you might want to learn about with respect to options trading. And one of the cool things about the new relaunch of the education series that we've been doing with TMX is the fact that we're now launching weekly cover call and short put reports, which is directly tied to this specific webinar, because we're going to talk about cover calls, we're going to talk about cash secured puts, and we're going to show you how to utilize these reports in your trading. So you'll be able to utilize the tools that we're going to show you here today with the different resources that you have available to you here at options plan. So let's go ahead and get started. Today we're going to talk about the top 3 income strategies using weekly options. Those 3 strategies are going to be cover calls, cash secured puts, and credit spreads. So if any of you that currently trade options, you probably are familiar with cover calls. Some of you that are familiar with cover calls really should be learning about cash secured puts. So if you currently trade cover calls, but you're not trading cash secured puts, I highly recommend this is a strategy that you should consider, because if you sell cover calls, that means you buy stocks. And if you buy stocks, you should really consider a cash secured put as a way to enter those stock positions. And for those of you that maybe don't trade any stocks or don't own any stocks, but you have some directional views on stocks or ETFs, credit spreads is the 3rd strategy we'll cover here today. That is really useful for anyone who wants to speculate on direction but still generate some income by selling weekly options. So those are the 3 strategies we'll explore here today. For each one, I will talk a little bit about the general best practices for expiration and strike prices. The thing about expirations across all 3 strategies is that they are fairly identical, but they are quite different from a strike selection. So I will dive into each one of the strategies and what are the appropriate ways to find optimal strikes for each one of those 3 strategies. We'll talk a little bit about how to gain consistency from these strategies. And I think that's probably the key for many users, is not how do I generate income, but how do I generate income on a consistent basis. So we'll talk a little bit about what you need to be doing in order to generate that consistent income stream for your portfolio. And then lastly, we'll talk a little bit about exit strategies, how to manage these trades before we jump over to OptionsPlay and show you some real samples of stocks and some real symbols for us to take a look at using OptionsPlay. So let's go ahead and get started. Like I said, what I'm going to cover are the 3 strategies: cover calls, cash secured puts, and credit spreads. So first of all, what I'm actually going to do is, most option income related educational material usually covers cover calls. That's usually the first and foremost, and there's a reason for this. It's simply because that's the first strategy you are capable of trading when you apply for an options agreement. It is the strategy that doesn't add any additional risk to your portfolio, so it's generally suggested as a starting point for anyone who's trading options, especially if you're trying to generate income. However, from my perspective, to sell a cover call, you need to first own the stock. And a lot of users ask me, well, if I have to buy the stock, is it something that I should buy just to sell a covered call? And the answer generally is no. The answer is you should only be selling covered calls on stocks that you want to own, even if you weren't going to sell those covered calls. Meaning it's a stock that you believe will appreciate in value. That's why you own those stocks. And that's part of why I genuinely believe that short puts or cash secured puts is a strategy that should be in anyone's. If you're selling covered calls, cash secured puts should be a tool that you should be utilizing in your toolbox, because it's a strategy that allows you to acquire shares that you want to own, and it's an alternative to purchasing the stock at an outright price. And the benefit of selling cash secured puts is the fact that you're able to purchase the stocks that you want to purchase with a discount by selling a put, as opposed to placing a limit order on the stocks that you want to own. So I always advocate, if you are selling cover calls, when you do purchase those stocks that you eventually sell cover calls on, take a look at selling cash secured puts. They allow you to dollar cost average in the stocks that you want to at a discount. Once you've purchased those shares, once you've acquired those shares, that's when you want to come back to selling cover calls, because you have to first buy the stock. So buy the stock with a cash secured put, then start selling cover calls. Cover calls, the goal here is to really add yield to the existing stocks that are in your portfolio. And the benefits of cover calls, I think, are fairly widely disseminated. Any of you have probably watched a webinar or a video or read a blog post on cover calls. You see that it generates income, but it also lowers the portfolio volatility and the net cost basis of the stocks that you own. So these two strategies really go hand in hand, because cash secured puts allow you to purchase stocks at a discount, and cover calls, and I'll cover this in the next few slides, really allow you to take profit on those stocks eventually when those stocks rally. So you really think about cash secured puts as a limit order to buy the stock and cover calls as a limit order to sell your stock eventually at a profit. If you think about those, if you think of cash secured puts and cover calls in those terms, it really becomes easy to understand why you should utilize these strategies, because when you place a limit order, you're going to effectively get the same result of placing a limit order to buy the stock and eventually placing a limit order to sell the stock at a profit. But to place those two limit orders, you don't get paid anything. But in order to sell a cash secured put and a covered call, you get an income stream. So imagine doing the same thing that you're already doing when you're trading equities in and out of your equity positions, but getting paid to wait for those orders to get filled. That's effectively what a cash secured put and covered call allows you to do by utilizing options as opposed to placing a limit order to buy the stock and sell the stock eventually at a profit in the future. So those two strategies really go hand in hand. Now, the third strategy comes a little bit out of left field. It is for those of you that have more of a speculative and an outlook on the underlying stock, because cash secured puts and covered calls, generally speaking, are strategies that we consider as fairly neutral, meaning you can enter those orders regardless of whether you are bullish, bearish, or neutral on a specific stock. They are meant to generate income while you wait for your orders to fill. While credit spreads are very specific to timing of the market. So when you think a stock is bottomed out, you can sell a credit spread to take profit on that, or take advantage of that and make a profit. Or if you feel that a stock is near its top or it's near a resistance level, you can sell credit spreads. Credit spreads are strategies that really allow you to generate income when you have either a bullish, bearish, or even a neutral outlook on an underlying stock. And this is really the only strategy of all the option strategies that allow you to take advantage of a neutral outlook on an underlying stock. So when I say neutral, I think a better description for neutral is not really neutral, because I don't really think of neutral as, hey, I think a stock is going to be where it is and it's not going to move, because I don't know of any indicators that tell me a stock's that's trading at 100 will also be at 100 a month from now. There's no indicator that tells me that. However, if a stock sells off from, let's say, 100 down to $80 and there's resistance at 80, that may be a neutral view where I feel the stock's not going to go any lower than 80. It might bounce a little, it might not go much higher, but I feel that 80 is a floor. That is what I consider more of a neutral view on an underlying stock. So if you have those types of views, that's really when you can utilize a credit spread to take advantage of that. So today what we're going to do is we're going to explore these three strategies. We're going to show you how to apply the best practices for each one, and then go through a few examples so that you can see how to utilize them. Now, before I jump into each individual strategy, the one thing that is fairly consistent across all three strategies is the fact that weekly options provide slightly better risk-to-reward ratios and income levels versus longer dated monthly options. And the reason for it is because of the time decay curve. So what I have here on my chart is the fact that as the premium of an option will erode as it approaches expiration, and the rate at which it erodes actually accelerates as you get closer and closer to expiration. So when you're further out, you get a much slower acceleration. When you're closer to expiration, you get a much faster acceleration. Now, because when you're selling options for income, you're effectively short that option. You want the value of that option to decrease, and you want it to decrease at a fast pace, or as fast of a pace as possible. So that's why when we're selling weekly options, we get that acceleration that we're really looking for. And that's why when you're selling any form of options, generally speaking, selling weekly options will provide you faster income than by selling monthly options. Because as you can see in that last month, I'm getting roughly the same amount of income for that 1 month as I do in the previous 2 to 3 months. So that rate of return that you're getting in that last month in terms of income is much faster than what you're getting when you're doing longer dated options. So yes, you do get more income when you're selling longer dated options, but you're getting that income at a much slower pace. So when we're talking about any of these three strategies, generally speaking, you want to focus your attention more on the shorter end of the spectrum rather than the longer end of the spectrum. Now, this doesn't necessarily mean that you have to trade weekly options. It just means that if you're looking at two different expirations and you're trying to choose between the two, skew towards the shorter end of the spectrum, because you're going to get less income, but you're going to get it at a faster pace. So how do we actually gain consistency from any of these specific strategies? And this is really where it doesn't matter which strategy we're talking about here. The goal to consistency is relatively straightforward. Number one, you want to choose consistent expiration dates and strike prices based on best practices. And those are the things that we're going to go over here today. And the key here is to be consistent, right? So what that means is that if you're going to pick weekly options to sell for cover calls, then you should stick to using weekly options every single cycle. Don't use 1 month options this month and then 2 month options the month after that. You want to stick to a consistent methodology for both your expiration date and your strike price. And the goal here is to simply use the same methodical approach every single cycle. That's it. That's the key to getting consistency in your portfolio. And the key to doing that, in my opinion, is really having some form of automation. And that's really what OptionsPlay is here to help provide. Because if you have to manually search through option chains to do that type of work, sometimes this is really where we lead to inconsistent results. So if you're using pages that look like this, and you have to manually select an expiration date and manually select a strike price, chances are month to month you're going to have some deviations away from a consistent methodology. When you use a tool like OptionsPlay that does the selection for the expiration date and strike price for you, we can guarantee that you're going to get a consistent application of the same expiration date and strike price, because that's what we've built into the program. And this is really what we're going to show you here today, is that what type of best practices do you want to apply to each one of these strategies so that you do get consistent returns every single month or every single cycle that you sell these covered calls for. So with that, what I'm going to do is I'm going to jump to the actual trading strategies and some of the best practices for each one. So again, what I'm going to do here is I'm going to start with short puts and cash secured puts, because again, when we think about cover calls being the first strategy that you learn as an income generator, yes, cover calls is the first strategy that you learn, but in order to sell a cover call, you must first own the stock. So that's why I like to start selling cash secured puts first. So cash secured puts, the goal here is to simply sell a put at a strike price below the current price. So imagine if you have a stock XYZ or BMO stock that's currently trading around $100 and you want to buy the stock at $95. What would you do? You place a limit order at $95 to buy the stock. So selling a cash secured put is really comparing to placing a limit order at a lower price to buy the stock. So again, you have a $100 stock, you want to buy the stock at a lower price, you would place a limit order at that lower price to buy the stock. Here, what we're saying is sell that put at the same strike that you would place a limit order for. And what this allows you to do is dollar cost average into those stocks at a discount, because not only do you purchase the stock at $95, just like a limit order, you get paid income to sell that $95 put. So likely you might own that put, that stock at $94 or $93, depending on how long it takes for you to acquire that stock or how long it takes for that stock to decrease down to $95. But you will always get paid something to sell that put, and whatever something you receive, that goes to provide a discount on the stocks that you own. So when you're selling cash secured puts, this is generally useful for when you have a bullish or neutral view on the market, and you find that you think the stock's going to pull back a little and you want to purchase the stock for the long term. That's when you want to utilize a cash secured put. Once you've sold that put and you've acquired that stock, now it's time to start selling cover calls. So cover calls, you want to sell the same calls that are less than 1 month. And here you want to sell cover calls at strike prices above the current price. And again, this compares to placing a limit order at a higher price till you sell your stock at a profit. So now let's say we own BMO stock at $94 or $93 after selling that cash secured put. Maybe we have a target price of $110 on BMO. So what would you do if you had a target price of $110 on BMO? If you were a stock trader, you place a limit order at 110, and you would wait for that stock to rise to 110 and have that order fill so that you can take profit on your BMO stock. However, when you place that limit order, you're just waiting for that limit order to fill. You're not getting paid anything to place that limit order. By selling a cover call, you can still sell a cover call at the same 110 strike, which gives you the same opportunity to sell the stock at 110 when it rallies, but it generates an income stream on your portfolio because when you sell that cover call, you're going to get some income. And as long as you're waiting for that order to fill, you can keep selling cover calls, and that's going to generate an income stream. And once the stock rises above 110, you now sell your stock, same outcome as your limit order, but as you wait for it, you got paid an income stream to do so. Many times the income stream that you get on a cover call is equal to or closer to double the yield that you're getting on the dividend for that specific stock. So this is really where once you've acquired that stock by selling cash secured puts, you sell cover calls, that generates an additional income stream. So you're really getting an income stream while waiting to acquire the shares, and then also at the same time waiting for those shares to appreciate in value and for you to take profit on that. And that's really the power of options. It really allows you to generate income full circle as you wait for that, full circle of your equities trade. Lastly, credit spreads. This is where, again, for those of you that have either bullish, bearish, or neutral a market outlook on an individual stock or ETF. So this is really encompassing all different scenarios that you could possibly, all different outlooks that you could possibly have on an individual stock. So when you're selling credit spreads, you also want to sell shorter than 1 month expirations. And what you want to do is you want to start by selling an at-the-money strike, so either an at-the-money call or a put. And then because selling an at-the-money call or a put is that neutral piece of the trade, however, selling a naked call or a put has unlimited risk. So in order to avoid having strategies that have unlimited risk, what we do is we buy an out-of-the-money call or a put against that, so about a 25 delta to limit your risk, because when you buy that out-of-the-money call or a put, you've effectively capped the risk of shorting that at-the-money call or put. And this is generally a high probability strategy for neutral directional outlooks. So I like to use this a lot when the market is oversold and I feel that a stock is near its support level. That's when I might sell a put credit spread. And when the markets are rallied very strongly and I feel that it's near resistance, that's when I would sell a call credit spread. And again, that is when I would consider the market as neutral, because that's where there's a high probability of the stock reversing in the other direction. But I don't necessarily even need a reversal. As long as it just doesn't keep going in that initial direction, I'm able to make money from this specific strategy. It's an extremely forgiving strategy, and it's a strategy that provides generally a high percentage of winners. So this is really a way to utilize the options as an income strategy while speculating on direction. So those are the three strategies, and just a quick explanation on time frame and expiration. Generally speaking, when it comes to selecting expiration dates, the shorter time frames that you go, what you're going to get with that is less income, but a lot more certainty as to what's going to happen between now and expiration. When you're utilizing longer dated options, what you're going to get is more income, but a lot less certainty. So a lot of users, what we tend to find, tend to gravitate towards the longer end of the spectrum. And this makes some sense because the longer end of the spectrum provides more income. However, like I said, what we generally find is that just because you're getting more income doesn't mean that you're getting it at a fast pace. So you also have to consider the pace at which that you are receiving this. So when you're thinking about expiration dates, make sure you also consider that time frame. But one of the reasons that we generally lean more towards the shorter end of the spectrum is really because when we sell short dated options, we want to generally avoid selling any options during earnings. Now, when we sell 1 month calls, we can do that 12 times a year, which means that 25% of the calls that we sell have this earnings factor built into it. But if we sell 3 month calls, we can only do that 4 times a year. Now, 100% of the calls that we sell have this uncertainty factor built into it. So if you're selling long dated options like 3 to 6 months out, you really cannot avoid earnings. So this is really why we generally always shy towards utilizing the shorter end of the spectrum. And the second part, again, and this is just a reiteration of what we spoke about here before, is that premium is not linear to time. So that when you sell a 1 month call, let's say you receive $1 for it. When you sell a 3 month call, you're not going to get $3 for it. You're generally only going to get about $2 for it. So that's why it doesn't make sense to go out 3 months out in time, because you're just not going to get paid 3 times the amount of income. So those are all the reasons why when we're looking at all of these strategies and we test the historical performance of these, we generally find selling shorter dated options provide you with better performance in the long run. When it comes to strike selection, this is really where it depends on how far away you are from the strike prices that you're selling. So when you sell strikes that are further away from the current price of the stock, you're going to get less income. We generally call these conservative strikes. So these are strikes that generally have a low probability of hitting. So we usually use delta. Delta tells us roughly the probability of a call or put expiring worthless. So a 10 delta refers to a call or a put that has a 90% chance of expiring worthless. So a very small chance that the stock's going to hit it. These are, again, refer to strikes that are very far away from the current price. So if you think about a cover call, it's a cover call that has a very high strike. Conversely, on the opposite end of the spectrum, if you're selling a cover call that has a very close a price that's very close to the current price, that's when you might find yourself selecting closer strikes, and you're going to get more income. But those closer strikes, generally speaking, are going to have a much higher probability of actually being hit. So about a 70% chance of expiring worthless. This is what we consider a much more aggressive cover call. Now, again, this doesn't matter whether you're talking about cover calls, cash and secure puts, or credit spreads. The further away you go, the less income you receive. The closer you go, the more income that you receive. And again, this differs as to the strategy that you're utilizing as to which ones is more optimal. So to talk about each individual strategy and what is more optimal, generally speaking, the rule of thumb here across the board, all 3 strategies, is you want to avoid selling during earnings. Going into earnings generally is not a good time to sell these specific types of strategies that have a directional component to it. So when you're selling cover calls, our backtest and our historical trades clearly show that when you're selling cover calls, you want to go for the more conservative strikes. So about a 15 to 20 delta call or a cover call is usually a suitable starting point. And the reason for this is very clear to us, is that you want to give your stock more upside to appreciate when you're selling a cover call, because that's actually where you have the largest, that's where you can make the largest gains. That's also your largest loss, is the stock leg. So you don't want to just sell a more aggressive cover call for an extra 20 to 30 cents while giving up a few dollars in upside if the stock does rally. So again, keep in mind that when you're selling cover calls, the primary reason that you're selling cover calls, again, is the fact that you own the stock and you think that stock's going to appreciate. So in order to give that stock room to appreciate before it gets called away, you want to make sure you sell very conservative strikes on your cover calls. Conversely, when you're selling puts, this is quite the opposite. When you're selling a put, you want to own that stock. You want to own that stock. So you generally want to shoot for more aggressive strikes. About 30 to 40 deltas on selling a put is usually a good starting point. And you want to look for a higher probability of exercise because you want to own that stock. You don't want to just pick up 20, 30 cents and lose out on $10, $15 of movement in the underlying stock. So when you're selling puts, choose more aggressive strikes. And lastly, with credit spreads, we've tested all different strike probabilities and combinations. It's very clear to us that there's one golden rule when we're selling credit spreads, and the goal is that you want to collect about a third of the width, and the width refers to the distance between the two strikes of a credit spread. And in order to try to collect a third of the width, you have to sell an at-the-money strike about a 50 delta and buy back about a 25 delta and out of the money strike. So those are the best practices as to what you should do to apply for each one of these specific strategies. Again, if you want to learn more, we do have webinars just on these strategies alone, each one individually, about a 45-minute webinar. So I do recommend that if you want to learn more about each one, to take a look at some of those webinars to learn more. So with that, just a quick overview of exit strategies before we jump over to options play. Number one, with all of these strategies, there is generally a time to consider getting out of this trade and potentially rolling it further out. And that's what we call a roll position. And generally, if you're going to think about rolling, this is something that you really only should consider within the last week before expiration. What that means is that if you're selling a cover call and the call goes against you after a few days, don't panic. Wait for the cover call to get closer to expiration before you need to do anything. And if you do need to take profit early, the rule of thumb here, generally speaking, is that you only want to take profit early if you have more than 50% gains and there's still more than 2 weeks left to expiration. So if you sold the cover call for $1, it's now trading at 20 cents, but you still have 2.5 weeks left to go. That's a good time to consider taking profits early and maybe selling another cover call. So the best way to think about cover calls, again, is consider the stock being called away as a take profit strategy on your stock. If you think about it that way, having a stock called away is generally speaking not a bad thing, because taking profit on a stock or taking profit on anything, generally speaking, is never a bad idea. So a lot of people get, I think, concerned about a stock being called away because of a tax bill or for whatever reason you want to own that stock. From my perspective, if the stock gets called away, that means the stock has rallied sharply. You've now taken profit and taken advantage of the fact that the stock has rallied sharply. That's a good thing. So don't think of the stock being called away as a bad thing that you want to avoid. Second of all, when you're selling cash secured puts, you want to make sure you maintain enough cash to purchase the actual shares, because again, this is a stock acquisition strategy. You must make sure you have enough cash on hand, or at least margin on hand, to purchase those stocks. And lastly, when you're selling credit spreads, one of the things that tends to freak some people out when you're selling this type of trade is that if you sell that put credit spread or that call credit spread, sometimes you find yourself you're either long or short that stock as an event because of the fact that the short leg gets exercised. So keep that in mind, that when you get exercised on a credit spread and you end up being long or short the stock, just because the position has changed, the risk of it has not. So if you replaced a short put leg with 100 shares of the stock, or a short call leg with a short 100 shares of that stock, it doesn't change the actual risk of the trade that you originally made. It still has limited risk. If this happens to you, you don't have to panic. Simply close out both legs. If one of them gets assigned and you don't want to hold on to the short or long leg, you can simply just close out the trade just like the credit spread. And you will be fine. You're not gonna take on additional risk because an assignment actually happened on a credit spread. So when you're trading that, be careful. But when those things happen, it's not the end of the world. So with that, what I want to do is I want to jump over to OptionsPlay. I want to take a few minutes and show you some of the tools that are available here to you, and how easy it is for you to be able to utilize these tools to quickly find opportunities to generate income. So for those of you that are brand new, OptionsPlay is available to everyone through the link that I sent before. I will send the link to everyone again afterwards, just in the chat window for those of you that want to register if you do not already have an account. OptionsPlay is a free tool available to everyone in Canada, and the tool looks like what you see on your screen. And it's divided into 3 sections. We have trade ideas and watch lists on the left-hand side. In the middle is our security analysis panel. On the right-hand side is our trading and income. So this is really what's designed to, we call these 3 panels the what, the why, and the how of options trading. So trade ideas and watch list are what symbols should you pay attention to in the morning. We have fresh ideas that are scanned for you based on technical scans, and we have pre-built watch lists for you so that you can quickly scan a list of stocks and see where to pay attention to. The security analysis panel is designed to give you snapshot technical analysis data so that you can see things like what is the short-term 1-month and 6-month trend, what is the technical score or relative strength ranking, so that you can score stocks from 1 to 10 and see what are the strongest stocks in the market, what are the weakest stocks in the market, and lastly, earnings, dividends, and price action data to give you important information or dates that are necessary when you're trading options. And the tool has the 1 month and 6 month trend below the chart so that you can actually see how that trend has changed over time, and see when and how long it's been in a trend for. And once you have a directional view on the stock, we have a trading tab that's designed to quickly help you find bullish and bearish trading opportunities on each individual stock. So if I'm bearish on Bank of Montreal, I can select I'm bearish, and this tool will actually populate 3 strategies for you to take advantage of a bearish view. And the main difference here is the fact that when you have a bearish view on BMO, traditionally you would have to use a page that looks like this. You would have to know that puts are a bearish strategy. You would have to pick an expiration date. You would have to pick a strike price first before you can see some analytics on those individual options. OptionsPlay, what we do is we actually select not only a strategy for you, but also an expiration date and strike price, and we put 3 of the most popular bearish strategies side by side so that not only do you not have to pick initially, we actually allow you to play around with these strategies and see how they perform, and then you can make your decision as to which strategy is best suited for you. And you can use this for both bullish strategies or bearish strategies, and we'll try to find as many strategies with the correct expiration date and strike price. And if something doesn't exist, such as if there's no call verticals that make sense on BMO, we'll simply tell you that we could not find you a call vertical. And this is designed to save you time so that you're not going through pages like this trying to find something that may not exist. And this is really why we created OptionsPlay, because as traders ourselves, we spent too much time looking at chains and pages looking like this, and many times finding that what we're looking for simply didn't exist because there wasn't a strike price or the premiums were too low. So we had to do a lot of legwork, and many times we were unsuccessful in finding what we wanted. So OptionsPlay is really designed to make that process as easy as possible for you so that you don't have to spend too much time on the option chains looking for something that may not exist. So today what we're going to spend is a little bit more time looking at the income tab. So for any symbol that you type in, on the income tab we will offer 2 options. You either own shares of BMO or the stock, and we'll suggest a cover call for you. Or if you don't own BMO, we will suggest a cash secured put for you. So this tool allows you to type in any stock. So in this particular case, I'm looking at BMO, which is trading at just around $100. If let's say I'm bullish on BMO, and notice here BMO, despite the fact that it has bearish trends, recently formed a bit of a double bottom right here around 98, 98 and a half or so. So maybe I feel that this stock is bottoming out. I think that this stock is ready to rally back up to 104, 105. So this is really where traditionally, if I was an equities trader, I would place a limit order at 99 or 98 and wait for the market to pull back so that I can get my order filled. Now, when I place that limit order, I have to set aside cash out of my trading account to satisfy that order. So that cash that sits aside is not earning any interest. I'm not getting paid for that cash. And that's again why we always advocate to consider selling a cash secured put in this particular case, because I can sell a July 26, 98 and a half put, which is comparable to placing a limit order at 98 and a half. But in here, what I'm going to get is $65 in income, which is roughly 0.65% of the underlying cost, because it's a $100 stock. If I'm going to collect 65 cents, that's 0.65%. So if the stock does pull back to 98 and a half, I'm able to annualize a 9.9% return, because instead of putting up almost $10,000 to buy the stock, I now only have to place 9,785 to buy the stock. So not only am I getting paid income, I have to put up the amount of cash that I have to put up to purchase the stock is at a slight discount, and that's a $65 discount. And if the stock does not pull back to 98 and a half by July 26th, I get to do it again, maybe collect another $65, and I can keep doing this over and over again until my order is filled. So again, this allows me to generate a yield on the cash that I'm putting aside to buy the stock that I want to purchase. Now, let's say 2 months down the line, I now own BMO stock at 98 and a half. Maybe at that point I've generated $100 in premium. So now I actually own the stock at 97 and a half. or my net cost basis is 97.5, now I can think about selling covered calls. Now I can say, well, if the stock rallies sharply to 102 in the month, maybe I might want to take profit. So this is really where now we'll tell you to sell the July 26, 102 covered calls, which generates $25 in income, which is a quarter of a percentage point. This gives you a 3.8% annualized yield, which actually isn't super attractive considering BMO already pays you a 4% dividend. So you're pretty close to that dividend yield. This is typically the bare minimum I would be looking for if I'm selling a covered call, but this allows me to start generating yield waiting for BMO to rally. And this generates $25 in income over just 24 days. So you can utilize this, or if you want to modify this, you can go a little further out in time. Maybe you want to go out to August. Maybe you want to go a little higher strike. So as you can see, the 103s will still give you $24 in income. So this really allows you to utilize this tool, type in any stock that you want to own or that you already own, and be able to quickly find ideas as to how to generate income on those particular stocks. So let's look at Canadian Pacific Railway trading at 309. If I was to sell a cover call, this is telling me to sell the August 16th 300 calls, $330 in income, which is roughly a 1% discount on the underlying stock if it does get filled. If it doesn't, I keep the $330. And then once I own this particular Canadian Pacific Railway, now I can sell August 16, 325 cover calls, and it gives me the yield, 4.66% yield on a stock that currently pays a 1% yield. Those are the types of returns that I'm typically looking for, because if I own Canadian Pacific Railway, I'm only getting 1% yield. I would like to add yield to it, and by selling covered calls, I can add about another 4% on top of that, almost 5%, which brings my total yield to 5.74% from 1%. Those are the types of returns that you want to try to seek when you're selling covered calls. Bank of Nova Scotia, same thing. It's trading at $70. This is telling me to sell the July 26 $70 puts. Gives me about a 0.5% discount on the stock if I'm able to purchase the stock at $70. Once I own that stock, I'm going to generate an additional 3.87% yield on a stock that does already pay a 5% dividend. So in this particular case, I would say that this covered call is not particularly attractive. I would probably not want to sell covered calls and only get a 3.8% yield on a stock that already pays me a 5% yield, because I'm going to end up losing that stock. So this is really where you can utilize this. You can use Royal Bank of Canada, and you can. This is really easy for anyone to be able to type in a symbol and quickly see a cash secured put and a cover call with all the details that you need to know how much premium are you actually receiving. So one of the things that I've noticed that in Canada, puts trade at a much higher premium than calls, which means that if you're, at the very least, you should consider selling cash secured puts as an alternative to purchasing the stock using a limit order. So lastly, with the last few minutes that I have here, what I want to do is I want to jump over to BMO. I want to take a look at selling a credit spread on BMO. So I'm going to see if I can find a credit spread here. So here BMO has a July 26, which is roughly 4 weeks out. Like I said, we always want to sell an at-the-money put, so about a 100 strike put, and then we want to buy back maybe a 98 put. So what we get here is a $2 vertical spread that I'm collecting a 60-cent credit on, which is roughly a third of the distance between the two strikes. 1/3 would be exactly $66, so I'm getting $60 here. So this would be an example of, if I felt BMO is near a double bottom, and I feel that this is likely going to at least stay where it is, maybe rise a little higher, selling this cash secured put is an example of selling that 100 strike put. So as long as the stock stays above 100, I make my maximum $60. If the stock was to drop a little, I can actually still make some profit, but I'll make less. And then my max risk is that the stock goes below $98. That's where I'm risking $140. So I'm risking $140 to try to make $60, but I have a relatively high probability of profit, about 57%. And this is an example of a bullish credit spread that you can trade on a stock like BMO, where I've identified a bit of a support around $98. I feel that it's bottoming out. I think it might rally a little. I'm not sure, but I'm pretty sure that it's not going to go below 98. That's when I want to sell that type of credit spread. And you can utilize this for, market bottoms such as um, BMO, and you can also use this for market tops. Like for example, let me see if I can find a market top. Let's say for some reason I felt that 310 was a high on Canadian Pacific Railways, and I don't think it's going to go much higher. Then I can select I'm bearish. Let's take a look at some. So July 19th is the only expiration here. So I would sell the 310 calls, the at the money calls, and I buy maybe the 315s or the 320 calls against that. So I'm going to sell the 310s, buy the 320s. So this is a $10 vertical. I'm going to collect $355, so which is again roughly a third of the distance between the two strikes. I'm going to collect $335 as long as the stock stays below 310. I'm going to collect $355. And this allows me to take advantage, as long as the stock stays below 310, to collect 355. But if the stock rallies up to 320 or higher, which is well above its 52-week high, but if it does happen, then I'm risking $645. So that's a quick overview of credit spreads. If you want to learn more about credit spreads, I do have a whole webinar just on that alone. So with that, what I want to do is I want to wrap this up. Again, for those of you that are accessing OptionsPlay for the first time, you can please register for it at optionsplay.com/TMX. I'm sending everyone a link into the chat window. If I hope that this platform or this demonstration was useful for those of you that are that are thinking about utilizing options or are currently already utilizing options, and helping you show the different use cases of options, that regardless of whether you want to own a stock or you already own a stock or you just want to speculate on a stock, that there are different option strategies that allow you to generate income. You don't have to just be relegated to only selling covered calls or thinking about cash secured puts. Really think about using all of these in your arsenal, in your toolbox, to generate a consistent income stream, so that regardless of what scenario you find yourself in, there's some option strategy you can utilize to generate some income. So with that, I want to thank everyone for taking the time out here this afternoon. What I'll do is I'll open this up for Q&A. If you have any questions, please type them into the chat window or the Q&A window that is at the bottom of your screen. So thank you so much for taking the time out. Please type in your questions. Jeff, I hope the sound issue that you were having in the beginning was cleared out for you. I don't think anyone else had any audio issues. Hope you were able to still continue watching. Peter saying, how do you deal with income tax when using options? So I guess that depends on whether you're in a taxable account or not. How to use options in a registered account. So my understanding is that for many users in Canada in a registered account, there are limitations as to what you can do, but I believe cash secured puts and cover calls at the very least are applicable. I'm not a tax specialist here, so it's hard for me to tell you what your tax implications are. So I do suggest that you talk to a tax specialist on that front. Peter's saying, does OptionsPlay show delta? OptionsPlay does show delta. So let's just say we're looking at a cover call. You can, or a cash secured put. You can click on the blue arrow, and we have a thing here at the bottom that shows. When you click on the blue, let me just do this slowly. On any of these P&L charts, there's a blue arrow. When you click on that blue arrow, there will be a button at the bottom that says Explain Strategy in Greek. So if I'm thinking about selling the August 16th 300 puts, this is telling me the delta here is 28. So this is roughly in that range of 30 to 40 that I'm seeking when I'm selling a cash secured put. And this is really what you should utilize to help you determine what delta to utilize. Those of you that use option chains, you'll typically see a delta on your option chain as well. Gene is asking about the portfolio tab. So the portfolio tab, unfortunately, is not something that will be released to Canada, at least not in any time soon that I'm aware of. What you're getting for free with TMX is a customized version that TMX is paying for. That's really what this is designed for. Does the platform show real-time data? Again, because this is a free tool that you are getting from TMX, there is no real-time data. Uh, could you please send a link to the Options Education Series webinars? Absolutely. So let me send everyone a link here. Just bear with me 1 second while I get that link. So I just sent everyone a link in the chat window to the YouTube channel that has all of our Options Education webinar series. Matthew saying, thank you for this great webinar that helped me understand the mechanics behind OptionsPlay strategy. You're very welcome, Matthew. Bradley is saying, in general, do credit spreads require less margin than cash secured puts? Absolutely. Credit spreads require far less. So if I'm selling this cash secured put on Canadian Pacific, if I sell the 300 put, I have to put up 29 grand to do that. If I sell a similar credit spread, let's see, if I sell the August 300, oh, there's not a lot of strikes here. As you can see, the max risk here is 420. So instead of 29 grand, it's $420. So your max risk on a credit spread is simply just, I'm sorry, your margin requirement on a credit spread is the max risk of that credit spread. So significantly less capital to sell a credit spread than a cash secured put. Silvano's asking, will you be uploading this webinar? Yes, all of our webinars will be recorded and sent to everyone afterwards. Jeff, good to hear that your audio was fixed. Banad, thank you so much. Thank you so much. I really appreciate it. Abu, thank you, Tony. Can we sell cash secured puts in Canadian registered accounts? I believe you can, but I guess that also depends on your broker. So I would highly suggest that you contact your broker. I believe you should be able to. Jeff, if you're having some issues with emails, if you don't mind, send me an email at info@optionsplay.com. I just sent the link to you in the chat window. Ed is saying, why take profits with more than 2 weeks? So Ed is referring to the slide that I had here. Take profits early if you've made more than 50% of your gains with more than 2 weeks left. The reason we say that is because you're effectively ahead of the trade, right? Meaning if you only have, let's say, 30% left to go and you still have to wait more than half the amount of time to gain that 30%, it's not worth it. It's not worth the risk because you actually have more risk in the last 2 weeks than you do in the first 2 weeks. So because of the fact that if you've made more than 50% gains in the first 2 weeks, you're well ahead of the game. Take profits, sell another cover call or another cash secured put. Those last 2 weeks is the riskiest because you start to have what we call gamma risk, because delta becomes very, very sensitive as you get closer and closer to expiration. So you tend to have these very large swings in your profits if you're close to the current price, if your strike price is near to the current price. So to avoid that, you just want to get out of the trade, sell a 4-week call again or a 4-week put, and you get to avoid that gamma risk. So that's why we generally tell you that if you've made more than 50% of your gains and you still have 2 weeks left, take your profits, do it again. Charles is asking a great question. What is the impact of ex-dividend dates with assignment if you are short? So generally speaking, you only have to worry about ex-dividend dates on a short call, because short calls are someone on the other side of a short call may want to capture that dividend. So what you generally want to keep an eye out for is the next dividend date. So we published that here at the bottom of your screen. We'll tell you when the next dividend date is, and you generally only have to worry about it as you approach dividends. And usually you only have to worry about it if the dividend is a large dollar amount. So as you can see, Canadian Pacific Railway is 83 cents. So 83 cents is a relatively large dollar amount for a dividend. So for those types of stocks, versus a stock that has a 1 cent dividend, there's almost no chance of a dividend capture. Even a 10-cent dividend is relatively low probability. So you really only, again, have to look out for, dividends that are greater than 30 to 40 cents, generally speaking. And if you're about to approach expiration just a few days, with about a week left and there's a dividend coming up, that's really the only time that you need to worry about dividends, and you're short the call. Jeanette, thank you so much. I really appreciate it. Heather, same thing. I appreciate it. Bradley saying, without options play, isn't your rule of thumb of collecting 1/3 the width of a credit spread a matter of trial and error? Or do the deltas 50 to /25 usually work out this way? Well, the deltas of 50 to 25 usually work out this way. And so those tools, usually what we use is 1/3 the width, gets us pretty close to 50 to 50/25 delta. And we use the 1/3 width as a rule of thumb when sometimes we don't have delta to look at. But either way, you get very close with either two of those rules. RK, thank you so much. I really appreciate it. Ed is saying, in my registered account, they don't allow cash secured puts as they're considered kind of like naked. So Ed, I understand. The whole point of cash secured is that it's not naked because it's fully secured by cash. But again, I think that really differs from broker to broker. So I do recommend that you talk to your broker. And maybe if your broker doesn't allow you to do that, maybe you should consider a broker that does allow you to do that if you find that it's a strategy that's valuable to you. So I hope that was useful. Again, thank you so much, everyone, for taking the time out here this afternoon. I really hope that you guys have found this useful. Like I said, this is where we will send the upload of the video along with the slides to YouTube, and then we'll send that out to everyone in about half an hour. So have a great afternoon, and I will see you guys in 2 weeks on our next webinar.